Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at strategy.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, so imagine a legacy enterprise software company, right? They look at their decades-old business model, basically throw it in the trash, take out a $42 billion credit card, and just use it to buy digital gold.
Yeah, it sounds crazy, but that is exactly the situation we are looking at today.
Right. It's wild. We are breaking down one of the most radical corporate transformations in modern financial history. We're looking at how strategy morphed from this quiet software provider into a $54 billion digital asset behemoth.
And honestly, whether you follow digital currencies closely or, you're a traditional value investor who usually screens for cash flow and solid balance sheets, understanding this is essential.
Oh, absolutely. It's a big deal for anyone managing a portfolio.
Exactly, because what we're seeing here is a masterclass in leveraged wealth building and, well, high stakes risk. It really challenges everything you think you know about how a publicly traded company is even supposed to operate.
Yeah, let's start with the sheer scale of their operations right now, because honestly, the numbers are almost difficult to process.
They really are.
Strategy has effectively pivoted completely away from their traditional software model. I mean, that legacy software business still exists, sure.
Right. It provides a baseline of stable operational cash flow just to kind of keep the lights on.
Yeah, it keeps the lights on. But their actual engine, their primary focus now, is acting as a proprietary Bitcoin treasury.
And the magnitude of this treasury is just staggering. They currently hold approximately $54 billion worth of this digital asset.
$54 billion.
Yep.
That's just massive.
It translates to nearly 700,000 coins sitting on their balance sheet right now. Yeah. To put that in perspective for you, that represents a massive percentage of the total global supply of the asset, all held by a single corporate entity.
700,000. And, they've signaled this incredibly aggressive target, right? They want to hit 1 million coins by the end of 2026.
That's the stated goal, yeah.
So that means they need to acquire roughly, 239,000 more coins in a really compressed time frame.
Right. And they're executing as a pure buying machine to reach that target. Just recently, they purchased over 1,000 coins for approximately $76.6 million.
Just vacuuming it up.
Exactly. And the week prior to that was even more aggressive, a massive $1.6 billion acquisition.
$1.6 billion in a week. That's insane.
They're deploying capital at a velocity that traditional corporations just simply do not attempt. They're basically buying up available supply from the market almost daily.
It's like, okay, think of it like a traditional tech company abruptly deciding its actual core product isn't the software it builds, but like the physical vault in its basement where it just hoards an asset.
That's a great way to picture it.
But I struggle to see how traditional finance rules apply here. How can we even call this revenue if they're simply hoarding a digital asset that produces zero cash flow? It just sits there.
Well, you have to completely discard the traditional income statement paradigm.
Okay, so throw out the textbook.
Pretty much. Revenue, in this context, has been entirely redefined by the company's management. They measure their operational success through a metric they call the accretion of the asset per share.
Right. Let's unpack that concept for the listener. Accretion per share, meaning they're measuring how much of the underlying digital asset backs every single share of the company's stock.
Exactly. That is their core growth driver. In a standard business model, investors look for sales going up and operational costs going down.
Leading to higher net income.
Right. And then you divide that net income by the total share count to get your earnings per share. Strategy ignores that entirely.
They just don't care.
Not at all. Their only metric of success is asking, does each share of our stock represent a larger fraction of a digital coin today than it did yesterday? If they can systematically increase the amount of the asset per share and the underlying asset appreciates in value over time, they view that as successful corporate growth.
So the product isn't software anymore. The product is just the continuous accumulation of the asset itself.
Exactly.
But that leads to an obvious mathematical wall, right?
Yeah.
You don't just find billions of dollars lying around in the corporate treasury to buy hundreds of thousands of digital coins. They have to pay for this somehow.
Yeah, and this is where the financial mechanics become incredibly complex. They unveiled this historic $42 billion capital raising program to fund this whole acquisition spree.
$22 billion. Let's break that down because that's a massive war chest. They're splitting into a few major buckets, right?
Right. They are aiming to raise $21 billion in common stock and another $21 billion in variable rate preferred stock.
Okay.
Plus, there's an additional $2.1 billion program specifically for an 8% dividend preferred stock.
And to make those variable rate preferred shares attractive to institutional investors, they've been aggressively hiking the rates, haven't they?
Very aggressively. They recently pushed them up to 11.5%.
Wow.
Yeah, they are willingly paying a massive premium just to get their hands on fresh capital to feed the buying machine.
Which brings up the glaring bear case here. The risk of share dilution seems just astronomical.
It's definitely the biggest risk factor.
Right. Like if I'm a retail investor and I own 1% of this company, and they flood the market by issuing $21 billion in new common shares and another 20+ billion in preferred stock, my slice of the pie just got mathematically pulverized.
On paper, yes.
So how does the stock price survive that level of extreme dilution?
Well, the stock price survives because the pie itself is theoretically growing faster than the slices are shrinking.
Okay, explain that.
Think of the mechanics. If a company dilutes your ownership by 10% by issuing new shares, but they use that newly raised capital to buy an asset that appreciates 30% in the same time frame.
Oh, I see.
Yeah, your smaller slice of the total pie is actually worth more total value. They're betting heavily that the net asset value of their digital treasury grows faster than the rate at which they're multiplying the overall share count.
But that's a massive assumption, especially considering their treasury is currently nursing a 10% loss.
That is true.
I mean, their average cost to acquire these coins is currently higher than the active market prices. To me, this feels like taking out a massive high-interest mortgage on your house just so you can buy more houses, while property values in your neighborhood are actively dipping.
That's a common criticism.
Right. If the stock is down 69% from its peak and the treasury is underwater, aren't investors just paying for the privilege of being diluted?
A mortgage is actually the wrong way to look at this, though. And this distinction is really crucial to understanding how they survive the volatility.
Okay, correct me. How should we look at it?
Well, if you don't pay a mortgage, or if the value of your properties plummets, the bank forecloses on you. They seize the physical asset.
Right.
In corporate finance, if you use traditional margin debt to buy a volatile asset and the price drops 50% overnight, the bank issues a margin call.
Ah, the classic forced liquidation spiral.
Exactly, the kind that destroys over-leveraged hedge funds. You are forced to sell your assets at the absolute bottom to cover the loan, which whites out the company entirely. But strategy isn't using traditional margin loans.
So there's no margin call.
No margin call. By funding these purchases through preferred stock, even with that heavy 11.5% dividend burden, there is no margin call mechanism.
Oh, wow.
The investors who buy those preferred shares cannot force the company to liquidate its digital treasury if the broader market dips. It's a highly specific, leveraged proxy structure.
That's fascinating. So it's a high-wire balancing act to service those massive dividends, relying entirely on the long-term appreciation of the asset. But it fundamentally removes that existential threat of a sudden market crash forcing a liquidation.
Exactly. They built a structural buffer against the volatility of the asset they're hoarding.
Okay, so the math works on paper if the coin eventually goes up. But Wall Street doesn't usually trade on theoretical eventually.
No, they don't.
What surprises me is that the market is actually rewarding them for this right now. And their peers are actively trying to copy the playbook.
They really are. The company's founder summarized in interviews. He stated, we just take the money, buy the asset, and issue the credit.
The ultimate stock sale machine.
Yep.
But competitors are actually holding Strategy's preferred shares on their own balance sheets now. People are looking at this financial engineering and calling it an iPhone moment for corporate finance.
It's quite the claim.
I have to challenge that narrative, though. The iPhone fundamentally changed how humans communicate and interact with global information. Is this really a technological breakthrough, or is it just aggressive, institutionalized FOMO disguised as financial innovation?
That's a fair question.
It just looks like they figured out a legal way to print shares, buy a highly volatile asset, and ride the hype train.
I would argue it is genuine financial innovation, even if it utilizes hype as fuel. I mean, you have loud, bearish skeptics, people like Peter Schiff, who slam this exact model.
Yeah, Schiff has been very vocal about this.
Right, warning that it's a house of cards built on endless dilution. And Schiff's argument is mathematically sound if the asset price enters a prolonged bear market.
Because the dividend obligations would just pile up.
Exactly, the asset drops, and the dilution destroys shareholder value. But the data from sophisticated institutional investors tells a completely different story.
What are the institutions doing?
Well, Strategy's preferred shares are currently trading above their $100 par value.
Wait, let's unpack that for the listener. Par value is essentially the face value of the bond or preferred share, right? Like the actual amount the company promises to pay back at maturity.
Yes, exactly.
So why does trading above that face value matter so much to the bull thesis?
When a preferred share trades above its par value, it means investors are willingly paying a premium over the face value just to own that specific yield.
Oh, I see.
It is definitive proof that massive institutional players genuinely believe Strategy can and will service its debt over the long term. They are evaluating the underlying digital asset, evaluating the company's leveraged proxy model, and voting with billions of dollars of institutional capital.
They believe the digital asset will appreciate enough to cover the massive cost of capital. But wait, why buy the stock at a premium instead of just buying the digital coin directly on an exchange?
Because for an institutional investor, self-custody of a digital asset is a total compliance nightmare.
Oh, right, the regulatory side.
Exactly. If a massive pension fund or a university endowment wants exposure to this asset class, they have to deal with digital cryptographic keys, complex cold storage security protocols, and intense regulatory hurdles.
Which they absolutely do not want to do.
No, they don't. Strategy solves this by being the largest corporate holder of the asset in the world. Buying shares in Strategy gives these institutions direct, leveraged exposure to the asset's price movements, neatly packaged in a regulated, publicly traded stock.
That makes total sense. That convenience and regulatory safety is exactly why the stock consistently trades at a premium to its actual net asset value.
Precisely.
So the presence of loud skeptics like Schiff is actually a feature for contrarian investors, isn't it? If everyone already agreed this was a perfectly safe, brilliant idea, that premium would already be priced out of the market.
Right. The heavy skepticism creates the volatility, and the volatility creates the opportunity.
The skepticism creates the entry point. But to understand how this plays out for you, the listener, we need to look at the immediate technical setup. We are looking at a critical 3 to 6 month catalyst calendar here.
Yes. Let's look at the recent price action. The stock recently closed around $138. It actually outpaced the broader market, which is highly unusual given the recent news cycle.
It is incredibly unusual because they just announced massive shareholder dilution.
Right.
Normally, when a company tells the market they're flooding the zone with billions in new shares, the stock price tanks immediately as investors flee the dilution.
But the fact that the stock is digesting this dilution news positively indicates the market has already priced in the worst-case scenario.
They're brushing it off.
Yeah, investors are treating the capital raise as fuel for the accumulation engine, rather than a desperation move to keep the lights on.
And since the stock is down 69% from its all-time peak, technical analysts view this as a potential distressed value setup for a swing trade.
Exactly. You have a beaten-down stock shrugging off bad news.
But a setup needs a spark, right? What is the actual immediate trigger that makes this stock move over the next few months?
There are 3 main drivers. First, the macro events driving the underlying asset itself.
Like what?
Geopolitical developments. For example, the U.S.-Iran ceasefire stability, combined with shifting domestic inflation rates, recently pushed the underlying coin up to $70,000.
And Strategy stock acts as that leveraged proxy we talked about.
Right. When the coin moves, this stock amplifies that movement.
Just to clarify for everyone listening, when we say leveraged proxy or a high beta trade, we mean this stock is like the underlying coin on steroids. If the price of the digital coin goes up 2%, this stock might jump 6% because of all the leverage we discussed.
Exactly. But the flip side is true. It falls just as hard when the market turns negative. The leverage always works in both directions.
Always was the second driver.
The second catalyst mitigates some of that downside risk through supply dynamics. The digital asset recently went through a halving event.
The halving. That's when the mathematical reward for mining new coins is automatically cut in half by the network's code, right?
Yes. It effectively tightens the incoming supply of the asset globally.
And historically, that tightening supply exerts significant upward pressure on prices in the months following the event, assuming demand remains constant or grows.
Exactly. But the third catalyst might be the most impactful from a traditional Wall Street perspective, and that is Q1 earnings.
Earnings. Wait, we established earlier that traditional earnings metrics don't apply to a company that just hoards a non-yielding asset in a digital vault.
They haven't applied historically, no, but the accounting rules just underwent a massive change.
Really? How so?
Well, under the old rules, if a company held digital assets and the market price dropped, they had to take an impairment charge on their balance sheet, basically reporting a massive financial loss to shareholders. But if the price skyrocketed, they could not mark the value up on their balance sheet until they physically sold the asset.
That's a terrible double standard.
It created massive, ugly volatility on their earnings reports. The income statement looked like a disaster zone, even if their assets were booming in value.
Because they couldn't claim the victory until they cashed out, which made the company look wildly unprofitable to algorithmic stock screeners.
Exactly. But the new accounting rules allow for fair value accounting of digital assets.
Oh, that changes everything.
In their Q1 earnings, Strategy can finally showcase the unrealized gains of their massive treasury. They can mark their holdings to the current market price.
Wow. If the coin stays elevated, it fundamentally transforms how their financial health is presented to institutional screeners and traditional value investors.
It is a massive shift in optics. Suddenly, screeners see a massively profitable balance sheet instead of a volatile mess.
Speaking of optics and forced buying, we definitely need to address the speculative chatter around S&P 500 inclusion.
Yes, there are persistent rumors floating around about the company potentially being added to the S&P 500 index. Now it remains unconfirmed and highly speculative at this stage.
Highly speculative, sure, but let's explain the mechanics of why that matters so much to the stock price.
Go ahead.
If a stock gets added to the S&P 500, every passive index fund and retirement account that tracks the S&P 500 is mechanically forced to buy shares of that company to match the new index weighting.
Right, it creates a tsunami of automatic price-agnostic buying.
Exactly. Combine that rumor with those resurfaced clips of the company's founder throwing out a $10 million long-term valuation target for a single coin, and you have a recipe for serious retail momentum.
Absolutely. When we evaluate all of this from an investment standpoint, the fair value accounting shift, the halving supply shock, and the technical setup, we are actually awarding the stock a 7 out of 10 bullish score.
7 out of 10. Nice.
It is a high-risk, high-reward entry point that heavily depends on macro geopolitical stability and the underlying asset continuing its upward trajectory over the next 3 to 6 months.
So if you are looking at this stock today, you have to clearly understand the thesis here. You are no longer buying a software company.
Not at all.
The legacy software business is just the regulatory shell. You are essentially entering a leveraged high beta trade on the tightening supply of a global digital currency.
The software business simply provides the reliable cash flow to keep the lights on, while the actual financial engine operates in the public markets.
Let's summarize the ultimate wealth-building takeaway here. Strategy has basically managed to create a perpetual financial engine.
They really have.
They take traditional Wall Street equity, they convert it into digital scarcity, and they repeat the process at a staggering scale. They took the physical vault in the basement and turned it into a $54 billion empire.
It's unprecedented.
It offers a unique, highly volatile vehicle for forward-looking investors who believe in the long-term appreciation of digital assets, but who require the regulatory safety of a publicly traded stock.
It is a remarkable execution of a singular vision, but, it leaves us with an incredibly profound question for the broader financial ecosystem.
And what's that?
If a single publicly traded corporation successfully executes its plan to hoard 1 million coins by 2026 using Wall Street capital, what happens to the core philosophy of a decentralized currency when one corporate entity holds such a massive, concentrated percentage of the global supply?